Welcome to This Explainer. Look, almost all of us share this one universal dream, right? We want to own property that just sits there generating steady passive rental income while we sleep, or, while we binge watch our favorite shows on the couch. Traditionally, pulling that off meant saving up a literal fortune, taking on massive loans, and then dealing with endless tenant headaches. But honestly, the game has completely changed. Today, there are these amazing new investment tools allowing everyday retail investors to own a tiny slice of sprawling office parks, luxury malls, and even national highways. So let's dive right in and unpack India's next big wealth creation opportunity. Here is a quick look at our agenda for today. We'll start with the real estate cost barrier. Next, we'll meet REITs and InvITs. Then we'll analyze their portfolio size and growth, take a look under the hood at their financial health and cash flows, and finally, we'll wrap up with valuations, payouts, and the risks involved. All right, let's jump straight into Section 1, Real Estate's Cost Barrier, or as I like to call it, the Big Hurdle. Okay. So the barrier to entry here has absolutely shifted. If you want to buy a physical commercial shop to rent out, you're looking at needing lakhs or probably even crores of rupees upfront. And to do that, you usually have to take on a heavy mortgage where the crazy high interest just eats right through your rental yield. Plus, it's totally illiquid. If you suddenly need your cash back, you can't just sell a brick-and-mortar building by pressing a button, right? But contrast that with REITs. It's wild. You can start investing with just 500 to 700 rupees. You get incredibly high liquidity because you're literally just buying and selling these units instantly through your Demat account, exactly like a normal stock. And the best part? Zero personal loan burden on your shoulders. It is a total game changer. Moving right along to Section 2, meet REITs and InvITs. And trust me, this is a massive 1.7 lakh crore market we're talking about here. So what on earth are these things? Well, if you understand how a mutual fund works, you've pretty much nailed this concept already. Think about it. In a mutual fund, thousands of people pull their money together, and a fund manager invests the whole shebang into the stock market. A real estate investment trust, or a REIT, and an infrastructure investment trust, an InvIT, they do the exact same thing. But instead of buying shares in companies, they use that massive pool of capital to buy premium, large-scale, income-generating physical assets. We are talking about the giant, shiny tech parks where Google and Apple set up shop, luxury shopping malls, and massive toll highways. Let me show you how this builds a really clear step-by-step pipeline. Step 1. Everyday retail folks and big institutional investors pool their money. Step 2, the trust takes that combined capital and acquires, or builds, premium commercial real estate or infrastructure. And Step 3, those properties start generating serious rent or toll revenues, and that income flows straight back into your pockets. It's quite literally a direct pipeline from your wallet to a prime commercial property and right back again. Now here is the absolute kicker, and it's a regulatory anchor mandated by SEBI. These trusts are legally required to distribute at least 90% of their net distributable cash flow back to the investors. 90%, no joke. This isn't like a regular company deciding to hoard its profits for a rainy day. If that sprawling skyscraper is generating rent, 90% of that cash flow legally has to go back to the unit holders. And that right there is exactly what creates that reliable, steady income stream that gives traditional rental yields a run for their money. All right, Section 3. Portfolio size and growth. It's time to systematically compare the giants. When we look at the sheer scale of these operations across 4 major REITs, Embassy, Mindspace, Brookfield, and Nexus, the numbers are mind-boggling. Embassy is an absolute behemoth. I mean, a 53 million square foot leasable area, they hold prime office parks across major IT hubs. But then look closely at Brookfield. They have been aggressively expanding with a growth rate of 19% per annum over the last few years. And you absolutely cannot ignore Nexus. They're a retail-focused REIT, meaning they deal in malls, but they boast an incredible 97% occupancy rate. Basically, almost every single square foot they own is rented out and generating cash. Now, shifting gears from commercial buildings to national infrastructure, let's take a look at the InvITs. We've got IRB handling highways alongside IndiGrid and PG InvIT in the power transmission space. IRB is out there aggressively expanding its highway assets. Hitting a rapid 26% per annum growth in enterprise value, IndiGrid is also on a buying spree with new transmission assets, bumping its value from 21,000 crores to roughly 34,000 crores. But then, look at PG InvIT. Their asset base actually shows negative growth. Why? Because they simply haven't acquired any new assets in years. Their growth has completely stagnated. Which brings us to Section 4, Financial Health and Cash Flows. Let's look under the hood at the money actually flowing through these trusts.
So, the big question, which of these REITs are successfully generating more cash to potentially increase future payouts to you? To answer that, we look at the net distributable cash flow, or NDCF growth. Remember that 90% payout rule we talked about? Well, obviously, you want that 90% slice of the pie to get bigger every single year. Brookfield is totally leading the pack here, growing its NDCF at a super impressive 21% per annum. Nexus is holding its own at 13%. Embassy, though, despite having that immense, massive footprint we saw earlier, has seen a much slower cash flow growth of around 4% per annum. Just goes to show, size doesn't always equal rapid cash flow growth.
Okay, now we absolutely have to talk about debt. Debt is a primary tool for expansion, but it's kind of like a double-edged sword, right? Look at this dramatic contrast in how these InvITs operate. Integrid is highly leveraged. Their net debt to assets under management is sitting at a really aggressive 59%. They are borrowing heavily to fuel that massive growth we saw. IRB is playing it a bit safer, taking a balanced middle-of-the-road approach at 31%. But then look at PG InvIT, an ultra-conservative 3.5% debt. I mean, they are taking almost zero risks with leverage, but as we saw earlier, that also directly explains why they aren't growing their asset base.
Finally, we funnel down to Section 5, valuations, payouts, and risks. It's time for the reality check.
Because these trusts trade on the stock exchange exactly like ETFs, their unit prices bounce around every day. You evaluate whether they're a good deal by comparing their current market price to their true net asset value, or NAV. It's actually fascinating. The market is currently giving a premium to the power transmission InvITs. Both Integrid and PG InvIT are trading above their NAV because, well, the market just loves the rock-solid predictability of the power sector. On the flip side, the market is pricing office real estate and highway InvITs at a discount. Embassy, Mindspace, Brookfield, Nexus, and IRB are all currently trading somewhere between 6% and 16% below their NAV. So from a strictly data-driven perspective, this means you can literally scoop them up at a relatively attractive discounted valuation right now. But hey, remember, the tax man always takes his cut. Since these are treated similarly to equities on the exchange, exiting your investment in under 1 year hits you at a 15% short-term capital gains tax. Actually, if you hold on to your units for the long term, that drops down to a 12.5% long-term capital gains tax. It is absolutely vital to factor these taxes into your overall return expectations so there are no surprises. Now, despite the heavy SEBI regulations and those beautiful, towering commercial buildings, I need to be clear. These are absolutely not risk-free investments. You have to consider market variables. For instance, if interest rates go way up, the yield you get on these trusts might suddenly look a lot less attractive compared to a simple, safe fixed deposit. If the economy hits a wall and slows down, those big tech companies might decide to vacate entire corporate floors, which instantly freezes your rental income. Plus, there are wild structural risks. Imagine a shiny new bridge gets built that completely bypasses your IRB toll road, or an oversupply of office space suddenly tanks the valuation of your Embassy Tech Park. You really have to go into this with your eyes wide open. So, what's the bottom line? REITs and InvITs have completely democratized real estate and infrastructure in India. You literally no longer need crores of rupees to be a commercial landlord. Equipped with this data, the power is totally in your hands now. The big question is, will you stick to buying traditional overpriced flats, or is it time you became a fractional owner of the giant tech parks and highways that are actively building India's future? Do your own research, weigh those risks we talked about, and decide what fits your portfolio. Thank you so much for joining me on this explainer today. Now go out there and build smarter wealth.